Think of the global economy as a massively multiplayer game. You drop in at level 1, and right away, hidden algorithms start draining your resources. Every single day, your financial health bar ticks down. Taxes take a flat cut of your income, while inflation silently erodes the purchasing power of whatever you have left. To survive this passive drain, many players panic. They dump their remaining capital into speculative assets, crypto, options, or meme stocks, hoping for a quick level up. Meanwhile, they ignore the toxic, high-interest debt that is actively compounding and eating away at their base accounts. Even elite players fall for this trap. Sam Bankman-Fried built a $20 billion empire by prioritizing aggressive growth over a structural defense. By chasing infinite expansion while carrying massive structural vulnerabilities, he guaranteed a total systemic collapse. His failure proves that stat chasing without a defensive base leads to a permanent game over. Surviving this system requires abandoning random speculation. Instead, you have to execute a mathematically precise sequence of exploits to patch your defense. This sequence is the wealth waterfall, a strict order of operations required to trigger systemic advantages and patch your account's vulnerabilities. The first essential block is the match exploit. This is a legal loophole where a corporate leader is contractually forced to double your pension deposit. This chart shows why the exploit works. A standard stock index gives you a historical average return of around 7 to 10% per year. An employer match, however, provides an immediate, guaranteed 100% return on your capital. Redirecting this money to pay off low-interest debt early is a mathematical error. The sheer volume of matched capital dwarfs the tiny amount of interest you save. Securing this risk-free loot is the mandatory first move to build base momentum before attempting to fight the rest of the market server. The next stage of the sequence directs that wealth into an impenetrable digital vault, shielding it from the government's tax algorithms. Tax-advantaged accounts like Roth IRAs or ISAs function as legal encrypted shields. They allow your capital to multiply for decades without the continuous drag of annual tax fees. Peter Thiel famously weaponized this exact mechanic to legally hoard astronomical wealth. By utilizing a standard Roth IRA structure to shelter his earliest tech investments, he built a $5 billion portfolio. Because it stays inside the shield, that entire fortune is completely immune to taxation. Most players leave their assets exposed in standard taxable accounts, suffering a compounding penalty on their returns every single year. True financial invincibility relies on securing capital inside these structural tax shields, rather than the fleeting gains of active stock picking. With defenses automated and capital shielded, the system transitions into an infinite engine of compounding growth. At this stage, your own psychological impatience poses a greater threat to the portfolio than any market crash or global recession. Every dollar placed in a broad index fund operates as a relentless, unpaid employee. It requires decades of uninterrupted work to successfully clone itself. Warren Buffett provides the ultimate proof of this mechanic. While he is one of the world's richest men, the vast majority of his multi-billion-dollar net worth arrived after his 65th birthday. His wealth was generated purely by compounding time, not early luck. Wealth is the mathematical guarantee that comes from inputting the correct sequence and letting the algorithm run completely uninterrupted.